Profitability ratio is used to measure the ability of a company to generate profit relative to sales revenue. It also shows how well a company utilizes its assets to produce profit. A higher ratio is more preferable as this usually means the business is performing well. The most commonly used profitability ratios are gross profit margin, operating profit margin, net profit margin, ROA and ROE. Gross profit margin is equal to gross profit divided by sales revenue. Let's say the gross profit margin is equivalent to 20 ringgit. Therefore, for every 100 ringgit of sales, RM20 ringgit gross profit was made before any expenses were paid. Next is operating profit margin. Operating profit margin ratio is a key indicator for investors and creditors to see how businesses are supporting their operation. If company make enough money for their operation to support the business, the company usually considered more stable. On the other hand, if a company require both operating and non-operating income to cover the operation expenses, it shows that the company operating activities are not sustainable. The operating profit margin formula is calculated by dividing the operating income by the net sale during the period. Many times, operating profit is classified as earning before interest and tax. Operating income can be calculated by subtracting operating expenses, depreciation, and amortization from gross income or revenues. The revenue number used in the calculation is just the total top-line revenue or net sales for the year. A higher operating profit margin is more favorable compared with a lower ratio because this shows that the company is making enough money from its ongoing operation to pay for its variable costs as well as its fixed costs. For instance, a company with an operating margin ratio of 20% means that for every ringgit of income, only 20 cents remains after the operating expenses have been paid. This also means that only 20 cents is left over to cover the non-operating expenses.